Okay, the next one is understand cost classification used in making decisions: differential cost, opportunity cost, and sunk cost. And the cost classification for decision making. Every decision involves a choice between at least two alternatives, and the goal of making decisions is to identify those costs that are either relevant or irrelevant. And in making the decisions, those costs that are not relevant should be ignored. So in order to understand this concept, it is important for you guys to understand the three concepts: differential cost, opportunity cost, and sunk cost. So let's move further. So differential cost and the revenue. The cost and revenues that differ among alternatives are called differential cost. So example will include that you have a job paying $1,500 per month in your hometown, and you have a job offer in a neighboring city that pays $2,000 per month. The commuting cost to the city is $300. So what is the differential revenue and differential cost? Differential revenue is your 500, 2000 minus 1500, and differential cost is 300. So one important point that I need to mention here is that the differential cost can be either fixed or variable. The next one is opportunity cost. The potential benefit that is given up when one alternative is selected over another. So these costs are not usually entered into the accounting records, but it must be explicitly considered in all decision makings. For example, if you were not attending college, you could be earning $15,000 per year. So your opportunity cost of attending the college for 1 year is $15,000. The next one is sunk cost. A sunk cost is a cost that have already been incurred and cannot be changed now or in the future as well. So sunk cost should be ignored when making decisions. So while the students usually accept the idea that sunk cost should be ignored on abstract level, like most people, but they often have difficulty putting this idea into practice. So one of the example is, suppose you had purchased gold for $400 an ounce, but now it is selling for $250 an ounce. So should you be waiting for the gold to reach 400 an ounce before selling it? You may say yes, even though the 400 purchase is a sunk cost, right? So the cost that you already paid and that is sunk and that cannot be recovered in future as well, we call this is sunk cost, and it is not relevant in decision making. So I have pasted a quick check here. So I just want you to pause the video here and just find out whether the answer is A or B, and I'm going to repeat it after. Once you just read out the question and pick a relevant option. Okay, let's read it together. Suppose you are trying to decide whether to drive or take the train to Portland to attend a concert. You have ample cash to do either, but you do not want to waste money needlessly. Is the cost of train ticket relevant in this decision? In other words, should the cost of the train ticket affect the decision of whether you drive or take the train to Portland? The answer is yes, because you do not want to waste the money needlessly. If the train ticket cost is very low as compared to your driving decision, you will definitely try to book the train. If the train ticket cost you more, or journey through train is more, because you need to stop over, you don't have to okay, you have to go for lunch, you cannot take pets with you, right? There are multiple options as well. So in that case, yes, the cost of the train ticket is relevant. Okay, now again a new quick check. Just pause the video, try to solve it by yourself, and then we're going to do it together. Okay, suppose you are trying to decide whether to drive or take the train to Portland to attend the concert, and you have ample cash and you don't want to waste the money needlessly. So is the annual cost of licensing your car relevant in the decision? So think about that. You already own a car and you have to pay the annual cost of licensing every year. So in that case, whether you go through train or whether go through your own car, you still have to pay the license cost as well. So in that case, the answer is no. The licensing cost is not relevant. Okay, now again the question is that suppose that your car should be sold now for 5,000. Is this a sunk cost? So in that case, because we are not given the, for example, we purchased it for 10,000, not 10,000, for example 16,000. So we are recovering how much? 5,000. It means sunk cost is 11,000. So this 5,000 cost is not a sunk cost because we are recovering this 5,000, but the cost that is sunk is 11,000. Okay, that's all from our lecture 2. So there is assignment 1. I will be pasting this assignment 1 in our Blackboard and also in our WeChat group. One important point is that please pay attention to the due date of this course, and remember that our assignment part is 40% of your total evaluation policy. Okay, before going to the finishing one, I have pasted a video, a very nice video which summarizes all the lecture 2, and it is very nice video that show you how these costs are classified or are considered in practical scenarios as well. So let's watch this video.
Further divided into differential cost, opportunity cost, and sunk cost. A difference in cost between any two alternatives is a differential cost. These costs can be fixed or variable. For example, the decision to make or buy a part requires distinguishing between costs that differ between the two alternatives. In some cases, differences in revenue will also be examined. For example, deciding whether to accept a special customer order, which may not cover certain fixed costs.
We have to, as managers, think through each decision independently and identify which costs are relevant and which costs are not relevant for that decision. Now, if we design accounting systems correctly, we can get categories that are going to be more useful for that purpose, but it's still not going to be automatic. Managers are still going to have to think very carefully about what costs are relevant, which costs are not relevant before making a decision.
Part of decision-making involves consideration of the opportunity cost. The opportunity cost is the potential benefit that's given up when one alternative is selected over another. For example, the contribution margin lost from cutting back production of one product to make room for the production of another. Finally, there are sunk costs. A sunk cost is a cost that has already been incurred and it can't be changed by any decision made now or in the future. For Clorox, the sunk cost of a specialized piece of equipment used to produce a new product would not be a factor if it becomes necessary to choose whether or not to continue manufacturing the product.
So that's kind of a cost of doing business in their introduction of a new product. If the product turns out not to be successful, we've clearly defined what our sunk cost is, and we understand how that's impact the organization.
However costs are classified, they are useful in understanding cost patterns, analyzing performance, and planning future operations. Ultimately, the decisions that a company must make dictates the method it uses for determining costs. A management accountant, like a good tailor, designs the cost accounting process that is best suited to the decisions made in his or her organization. Whatever the business, cost classification is based on how cost will be used, preparing external reports, planning budgets, and making decisions. When valuing inventories and determining expenses for the balance sheet and income statement, costs are classified as either product costs or period costs. Period costs are costs such as rent and administrative expenses, which are tied to a reporting period rather than a specific product. Product costs are raw materials, labor, and manufacturing overhead that can be traced to a product. To help management track and assess expenditures for planning and decision-making, costs are sorted into additional classifications. For predicting cost behavior, such as the impact of increasing output at a manufacturing plant, expenses are classified as variable or fixed. To assign costs to objects for pricing, profitability studies, and control of spending, costs are classified as direct or indirect. And finally, to help management compare alternatives, costs are further classified as differential, opportunity, and sunk. In the end, calculating costs isn't a cut-and-dried process. Managerial accountants must tailor internal and external reports to reflect each company's unique cost issues.
Okay, that's the end of our chapter 2. So you are more than welcome to post any ambiguity or queries regarding our lecture 2 in our Blackboard discussion or in our WeChat group as well. See you for the lecture 3. Take care. Bye bye.